Good morning, everyone. I'm Luiz Pereira da Silva, the Deputy General Manager at the Bank for International Settlements. It's a pleasure to participate in this seminar of Euromoney and borrowers and bond investors. My presentation today will focus on global risks such as climate change and also naturally COVID-19, but I will try to show how these global risks can also be investment opportunities for the private sector. So let me go through my presentation now. So I will address these global risks, and I will try to show how the solution for them can bring benefits to all with contributions from green finance and the private sector. This is work that has been revolving around the book that we released earlier this year that is called the Green Swan and deals with central banking and financial stability in the age of climate change. The outline of my presentation will focus first on a bit of a taxonomy of global risks and how and why we call them green swans. Then the fact that these risks seem to be mispriced currently, at the same time that there is growing social awareness about the fact that they do entail a cost for societies. Therefore, we advocate the need for global coordination and for global cooperation regarding these risks. Of course, then the private sector has been working on many practical solutions, particularly in the realm of what is called the green finance. And finally, I will close the presentation talking about some challenges and opportunities of a green recovery. Now, global risks and why is it that we call them green swans? These global risks, such as climate change and also now COVID-19, are essentially very, very large global negative externalities. They have barely, if at all, priced. And in any event, we believe that there's been an underpricing of these risks. And they might be behind the many weather events that we've been seeing, particularly last year, causing very large damage, particularly because of the lack of full coverage by insurance. And therefore, they are a threat to financial stability. And this is why 65 central banks regrouped into what is called the NGFS, the Network for Greening the Financial System, and that includes us at the BIS. Now, when you have global risks, the solution requires global coordination among many agents. And it requires, of course, talking to governments, to civil society, but naturally it also involves everyone, particularly the private sector. And the solution requires behavioral change. We know that when we deal with carbon tax or with the solutions for climate change, there is always issues of collective action. Who should do things first? And of how to incentivize cooperations among agents, for example, who should pay for what? And until recently, I think we have such a something like a myopic behavior. It was called the tragedy of the horizon by Mark Carney, that people couldn't really see the utility of doing something because the risks of climate change were so distant in the future. But now, with this new type of global risks, such as the pandemic of COVID-19, this might have bring some changes in terms of our behavior, because The global sudden stop that we are living currently and struggling with has provided an overwhelming evidence of the huge cost of these green sands, and hopefully convincing societies of the need for protecting themselves against these risks by insuring themselves and by having some buffers to absorb these shocks. Now, in the book, The Green Swan, we try to reflect on a taxonomy for these global risks. And I'm sure that everyone is familiar with what is commonly called black swans now, after the work of Nassim Taleb, just before the global financial crisis. And everybody also knows, let's say, the more common situation in which we appraise risks, let's say, following a white swan type of typology. What is the difference between black swans and green swans? Think of black swans as the manifestation of the global financial crisis, and green swans as the new way in which you can characterize climate change and pandemics. I think one big difference is in their predictability. Remember that black swans were always considered tail risks. They were a surprise for people watching the event, because it wasn't really coming from historical data. Now, green swans, on the contrary, such as climate change and pandemics, they are quite likely or certain in terms of their occurrence. What we don't know is the timing of their occurrence, the when, and how exactly are they going to manifest themselves. They are much more complex phenomena than, let's say, a global financial crisis. Another way of differentiating them is that for black swans, things were essentially modeled by financial analysts and economists, whereas for climate change and pandemics, the main explanation is given by nature scientists. Now, of course, all of these events have massive impacts, both black swans and green swans. But in one case, the impact for financial crisis, for example, is mostly material and possibly corrected after the crisis, whereas for green swans, the massive and direct impact is mostly to human lives. And there is a suspicion that these impacts are irreversible once you are in a situation of a rise in temperatures. It's the damage is final. Finally, a main thing to consider in the difference between these two types of characteristics is that for global financial crisis captured by black swans, what you need is actually to sort of reconceptualize your approach to risk. You cannot use anymore the kind of traditional normal distribution of events that is very convenient to assess common events. But you have to essentially do a different approach to risk. Now, in the case of green swans, I think it's much more complicated because of the various cascading effects and the complexity of these types of events. And nonetheless, you need to have immediate action and coordination, even if there is radical uncertainty. Now, why would COVID-19 be associated with a green swan and climate change? Now, you can see that, of course, it ticks all the boxes that I have just described as green swans. But I think the main point here is that these types of pandemic somehow, as portrayed by our best scientists, are related to the destruction of our natural habitat by climate change. The fact that we have been losing our biodiversity is something that scientists have been warning us as an element of losing a bit of the resilience for life in general in our ecosystem. And this is related essentially to the way we've been urbanizing, we've been creating transportation networks, we've been industrializing our agriculture, there's been a lot of deforestation. And with that, our activities are much, much closer to very well-known vectors of viral diseases. Think, for example, of bats. And therefore, environmental and health crisis, I think, can be therefore understood jointly and potentially reinforcing each other. Now, there is also a more speculative way in which climate change might relate to pandemics. You may know that there is this idea that if the permafrost in the Arctic melts, you might sort of unearth some ancient viruses for which we are not anymore immunized. But this is a bit more speculative. Now, these climate change risks have been increasingly recognized as the biggest risks that we are facing. Think of this famous picture in the World Economic Forum report about global risks. You can see in the top corner the green dots. All these are climate-related global risks like biodiversity loss, extreme weather, natural disasters, and so on and so forth. So the risks are big. How are they priced? Well, these global risks continue in our understanding to be mispriced, and this comes essentially because traditionally we use backward-looking risk management tools, and they cannot model well and quantify these risks because they take data from the past, and the data from the past is not necessarily the best guide for the future. And therefore, what we need is essentially a sort of epistemological break, meaning that we need to change our minds. Our minds are essentially comfortable with historical, linear, deterministic models. And in the case of these green swans, climate change in particular, we are dealing with very different, complex, non-linear phenomena with cascading effects that are cross-border and cross-sectors. And therefore, what you need is a sort of a much more holistic, scenario-based, forward-looking type of approach. You need really a sort of a significant methodological change to sort of be capable of grasping these types of events. Many alternative approaches have been suggested in terms of relying less on equilibrium models such as the SGEs and more on holistic approaches, on sensitivity analysis, and also the fact that in addition to price changes using carbon taxations, you might need, suggested by Joe Stiglitz and Nick Stern, complementary approaches with regulatory interventions and other public policies. So bottom line here is that we need to sort of acknowledge that these green swans, particularly climate change, but pandemics as well, we're dealing with radical uncertainty here in terms of the type of phenomenon we're dealing with. And just to illustrate this, look at, let's say, these are events in the Earth map that you have on the left of, let's say, tipping points that can trigger these cascading effects. And you can see that these tipping points, of course, depend on the rise of temperature that might be triggered by our human activities on the planet. but they are very sort of complex to model. Think of a couple of them, like the melting of the Arctic ice sheet. Think of, let's say, permafrost. Think of the circulation of currents in the jet streams. Think of the Amazon rainforest destruction. These are very complicated events, particularly even the sort of models, the integrated assessment models that deal with climate change. And this is an incredibly strong literature pioneered by Weizmann. They have difficulties in modeling this complexity. Another type of mispricing that you might have heard of in terms of transition risks is the fact that you might be facing something that affects financial stability, which is a sudden repricing of some assets because precisely of climate change related risk that can affect and change the demand for a particular commodity. And naturally, think of oil prices, for example. You can have the illustration here of, let's say on the left, some of the dramatic drops of oil prices during the global financial crisis, and now with the COVID-19 crisis. And on the right, you can see the immediate impact or the corresponding impact on asset prices of the industries. Now, if these events happen because of a pandemic or well, in this case of the global financial crisis, it was a typical financial crisis, but think of this happening in many commodities at the same time across the globe, you could trigger with that a severe financial crisis and a sudden stop, such as the one we are living today. Now, fortunately, there's been growing awareness in the central banking community as precisely having these green swans, climate change, as a source of financial stability. So many central bankers, financial supervisors, and regulators know and are realizing that these events can bring systemic risks, and these systemic risks will impact financial stability. We've been having a number of declarations, most prominently by Mark Carney, and this prompted, as I was mentioning at the beginning, the creation of the Network for Greening the Financial System in 2017, a group, a coalition of the willing central banks to address these global risks. The growing awareness is also brought by, let's say, some of the consequences of these global risks. And this has been particularly revealed by COVID-19. Look at some of the huge ex-post costs of these events, of this pandemic, as reflected by some of the indicators in these graphs. Look at the severe drop in PMIs. Look at the exponential growth and the surge in jobless and in part-time workers in the US and in Europe due to COVID-19. And look at the financial consequences of COVID-19 in terms of the dramatic fall in global stocks. Another example that I think shows that people are becoming aware of the relationship between climate change and the well-being is the difference in terms of pollution in China before and after the sudden stop caused by COVID-19. You have on the left the concentration of nitrogen dioxide over China before the pandemic and before the quarantine, and then a few weeks later during the quarantine, the disappearance of these pollutants. So all this brings us to the need for global coordination and cooperation. And essentially, what I described just previously in terms of growing social awareness, both by the general public, but also central banks, I think my hope is that this might be triggering a greater acceptance for some form of insurance against these green ones, because the cost of these global sudden stops is really sort of tremendous, enormous vis-a-vis the cost of preventing them. Now, if you want to sort of price the risk of a pandemic, this is not necessarily like the traditional carbon taxation that we think about for climate change. Think of it more like an insurance. Think of it as the portion of, let's say, the risks, the public health risks of a pandemic that can sort of be factored in the way we produce, we transport, and we consume things. And I think this is an important issue, insurance, because it illustrates the benefits of cooperation and the huge benefits that it can bring and the relatively small cost of insurance. Remember that, for example, just to give you a concrete example of small cost of insurance. Remember the tsunami that hit the Indian Ocean in 2004. This caused a tremendous devastation to people and also to countries. And because this is associated with no early warning system in place, and now with cooperation, with an investment of relatively small amount, 200 million, and the annual operating cost of about 25 million that is shared between 28 countries, you have now a very well-functioning insurance and early warning system. The cooperation is not only between countries, I think globally, but also locally. This growing social awareness is also pushing people to accept, to cooperate, of course, with regulators in the financial sector, with governments and their development banks when they exist, of course, with national treasuries, particularly when you want to trigger a green fiscal policy, with international financial institutions, with standard setters, and of course, and very importantly, with the private sector. Now, central banks are doing their part, and they are also investing in green bonds and in green finance, and the BIS itself launched very recently a green bond fund, because essentially we saw a lot of demand for sustainable investment. This is increasing among central banks. We know that the green bond market is growing. And I think we have a responsibility as central banks to engage in the design of best practices. And indeed, we conducted a survey that highlighted the major benefits of promoting green financing, and particularly green bonds. And central banks responded quite strongly with the fact that promoting green financing has both a reputational benefit, and it is also their preference for portfolio diversification, as you can see in the graph in front of you. It also is associated with the fact that there is a very, very positive moment in which green bond issuance is continuing to grow, particularly because the issuers are global players. If you look at the graph on the left, you can see the growth of the outstanding amounts of green bonds by currencies, by headquarter countries. You can see the importance of course, the US, but particularly also some of the European countries and also China. And you can say that the stocks are evolving towards probably now something that is very close to a trillion dollars, and the amount of gross issuance in the graph on the right on a year-by-year basis has been going very, very well. You can see also in these two graphs that there is increasingly a very comparable type of rating in terms of the green bonds and conventional bonds. You can see that the ratings of issuances on the left for green bonds have been manifesting a growth of AAA and also single A's and double A's across the period 2014-2019. And the percentages now of very good ratings for both the green bonds on the left and the conventional bonds on the right are pretty much the same type of quality in terms of investable instruments. And the good news is that this is very much supported by central bank. I think a survey that we conducted show here in this graph, in this pie chart, that almost 63% of the respondent central banks, reserve managers of central banks confirmed that they think there is a scope to include sustainability as a reserve management objective, in addition to liquidity, safety, and return. And we also, in the same survey, identified that green bonds are probably the most common way in which central banks include green financing. And this is also followed by the introduction of ESG criteria in their reserve management activities, as shown as well in this graph. Now, central banks are one thing. What are the sort of practical solutions that the private sector can contribute with green financing, but also with other ways in which they can reduce global risks? I think first, the private sector will be looking, particularly now with COVID-19, at the trade-off between efficiency and resilience of their production and logistical networks. I think inevitably, because of some of the shortcomings that the pandemic has shown us in terms of being unprepared, there will be reflections about the way in which our global value chains that require no interruption, that require just-in-time production systems, need to be protected against these risks, and particularly these green swans. The location matters, the way in which you organize your system matters, and perhaps people are beginning to already stress test their global value chains, see if they can sort of create some buffers and try to sort of respond to these types of risks. Think of banks, for example. After the global financial crisis, everyone realized that they needed stronger loss absorption capacities, buffers, more liquidity, and so on and so forth. And I think the private sector is already learning from this COVID-19 green swan, that he needs to react to become more resilient. And basically it will say, look, I need to look at perhaps different types of locations. I perhaps need to look at the way in which I cannot be only dependent on one type of line business. Even if I excel in this line of business, I might wish to diversify a bit more my activities. And this is a bit against the tendency that went from the 50s to the 70s and the 80s, where specialization was paramount, where you needed to be very, very efficient and sort of specialize yourselves instead of being a bit more perhaps resilient, but having a more diversified set of activities. I think the private sector is also looking at these changes in perceptions vis-a-vis climate change related risks that societies are now very much aware of. And I think it should be seen as opportunities. Think of the situation vis-a-vis climate change about, I don't know, 3 to 4 years ago on the left-hand side of this slide, where you had many people were denying that this was a risk. Many people, I mean, nobody had the really agreement about that. There was no global arrangement. There was a role that was a bit more negative by China. You have very limited interest across societies. It was something that was only about economics. It was a very abstract topic. The alternative for fossil fuel consumption, the renewable energy, was very costly. And you have very, very limited set of investors. Now, today, I think, particularly after the dramatic events of last year's accidents and weather catastrophes in Australia, in California, in Brazil, you have, and of course, the mobilization of civil society, you have a greater acceptance of climate change. You know, and I showed you the World Economic Forum portrait of risks. We know that these are the biggest risks that we can face. You have a bit more of coordination with the COPs 21, 22, and so on and so forth. China is now perfectly capable of leading this combat against climate change. We know that many people in society are interested and concerned about this. It's not about economics anymore. It's about also health, and COVID-19 is a dramatic proof of this. We are observing this on our daily lives. And of course, the renewables are less costly and much more competitive. So the whole thing has been changing positively, and it is reflected in the number of news that you can see all over the press and newspapers globally. Now, what other opportunities arise for the private sector? Well, think of the amount of ESG assets. They offer a $30 trillion market opportunity globally. It represents about 40% of global assets under management. You can see that is the market, or the potential is very well diversified between the Americas with Canada and the US, but also Europe and also Asia. And it has been growing at a fast pace, 34% growth in the last 2 years. And particularly, it has a potential. This is a study by Deutsche Bank. The global assets under management that fall under an ESG mandate is now around 30 trillion, but it has a potential to grow probably up to 45 trillion, 50% total asset under management by next year, and it can even represent about 95% of assets under management around 2013. So it's quite a dramatic and positive move by the private sector. This comes along with the growth of carbon initiatives, showing these are the quantity of these initiatives in the last couple of years, in recent years, since 2005, and it portrays with these initiatives the share of global greenhouse gas emissions that are covered by these initiatives. And you can say that it is a multitude, and it is essentially growing very dramatically since the mid 2000s. Now, of course, this has a lot to go, but it is a message that this is happening as well, together with, of course, the evolution of carbon pricing in recent years. This could even be bigger, but it is also happening as shown in this graph portraying the EU carbon prices recent evolution up now to something around 25 euros. Now, another very positive news is the fall in the cost of producing renewable energy. Remember that this was one of the impediments for greening our production systems, but since let's say the global financial crisis, this graph shows the dramatic fall into the average values for producing a megawatt of energy, and you can see that basically the solar and the wind, these are the blue lines, and the green lights are now falling behind the more traditional fossil fuel costs, such as coal and even nuclear. So this is also a signal that we do have, in terms of cost now, the capacity to begin shifting our energy matrix. So to summarize, the private sector in green financing and in anti-pandemic financing has a tremendous key role to play, participating in improving the financial instruments. I think seizing the opportunities to invest in these green instruments. You can see that this is also being incentivized by behavioral changes in some big funds. Think of Norway's wealth fund that have been excluding, for example, coal from its portfolio. I think the private sector can also strengthen research partnership to develop green technologies. For example, all these renewable energy, but also carbon capture, and also anti-pandemic research and policies. I think everybody has to pull together in terms of improving, as I mentioned, the methodologies to measure global risks, and also to begin thinking of how we can translate these costs into some form of insurance. And I think last but not the least, participating in identifying and financing investment opportunities for a green recovery. And I will finish this presentation by rapidly talking about these challenges and opportunities. Now, is it possible to have from this dramatic crisis, out of which we are not even yet beginning to see the end of the tunnel, to get out of this a green recovery? I think it could be a win-win. And remember the say that you should never waste a crisis. Therefore, let's try to think about how to mitigate the carbon footprint in the future recovery. Now, of course, let's not be naive. We know that there are many challenges, and it's very difficult to consider a recovery with a lower carbon footprint, because essentially of the need, given the amount of debt that has already been accumulated, to minimize the length of contractions. And we know that there's going to be vulnerabilities that will be very, very large in the real and the financial sector, probably much bigger than after the global financial crisis. So I think everybody will feel, policymakers and CEOs of big corporations, a lot of pressure to go fast and not necessarily to add an additional difficulty in this recovery. And we know that there is a lot of uncertainty about the recovery itself, because some of the parameters that we economists have to sort of forecast the recovery, such as what's going to be the interest rates, what's going to be inflation, what's going to be the equilibrium natural interest rate, are all under a very great deal of uncertainty. Think of, for example, whether the crisis will trigger more precautionary savings or not, whether people will be keen in going back to their old consumption habits. So all this are challenges and are difficult to grasp. Nevertheless, I think we should consider some lessons. And this is coming from the fact that, as I was mentioning at the beginning, there might be some behavioral change that is going on in societies. This is what economists call behavioral contagion theory. It means that people do not believe in something or the sort of the risk that that this something represents until they see the overwhelming cost and the effects of such a risk. And I think we might be particularly now after COVID-19 in the sort of tipping point where societies really begin to fully internalize and understand the complex of the danger of these complex global risks. Think of people that were with the impression that climate change were only a distant phenomenon, and now they have the vivid example of something that can hit us and hit societies and disrupt our lives much more rapidly than they thought. And there are, let's say, ways in which this behavioral changes will sort of trigger responses on public investment programs in terms of research, but also perhaps in the way some very large markets would enact different types of norms in terms of being more protective to the environment. And this, if the region, if the market is large enough, and for example, Europe, but also China and the US this would create incentives for firms to accelerate their adaptation and mitigation to a lower carbon economy. So I finish with, let's say, the opportunities that the private sector might have in terms of investment and financing in the aftermath of these this COVID-19 green swan. And if we go through this list, you can realize that it can indeed be the basis for a very productive, very different, but very sustainable recovery. Think of investing, for example, in clean connectivity infrastructure, because inevitably we will have these new habits coming from working from home. Think of this very seminar that I'm giving right now, which used to be in front of a physical audience. Many things are happening that are changing our behavior. Think of, let's say, if we work more from home, that we might wish to improve our neighborhoods, our natural environment. Think of, let's say, the investments potentially massive in clean energy infrastructure. Think of, let's say, working on our houses, our building, retrofitting them, using cleaner energy, more insulation. That would certainly lower the carbon footprint. Of course, think of investing into green research and development. This is a must-do in terms of not only renewable energy, but also carbon capture techniques. And finally, last but not the least, think of investing in training, because what is happening with COVID-19 is an acceleration of the move towards a more digital economy. And this will create a lot of redistributional difficulties, because some of the skills that are required to move into teleworking, into the digital economy, are just not there for many of us, but particularly for the younger generation. And all this needs to be enhanced, particularly if we want to avoid massive youth unemployment, but also in general, much higher and perhaps even permanent mass unemployment. So all this is something that is food for thought for the private sector. This is something that in terms of opportunities for investment and financing are huge. And I would just sort of stop here with this presentation. And to conclude, I think that COVID-19 has been a moment, or is a moment, for creating new and strengthening very old synergies between the private sector and the public sector. I think it's really a big opportunity for all of us to work together towards a new pattern for the way in which we produce and we consume. And with these very large opportunities that I just portrayed, it can be seen as a way in which we can all work together for the common good. I thank you very much.